What if I told you that when you deposit money in a bank, that money's almost immediately gone? Not stolen, not lost, just lent to someone else. Most people believe banks simply store their money safely in a vault. But the reality is very different. To understand how the financial system works, you need to understand what banks actually do with your money. Imagine you walk into a bank and deposit $1,000 into your account. The cashier takes the cash, counts it, and confirms that the money has been added to your balance. You leave the bank thinking your money is now sitting safely somewhere inside the building, maybe in a vault. But in reality, that money does not just sit there. Banks do not operate like giant safes that simply store cash. Instead, they act as middlemen in the financial system. Their job is to connect people who have money with people who need to borrow money. When you deposit $1,000 into a bank, the bank usually keeps only a small portion of that money available. The rest of it can be lent out to someone else. For example, if you deposit $1,000, the bank might keep a small fraction in reserve and lend the rest to someone who wants to buy something like a car, start a business, or purchase a jet ski. This system is called fractional reserve banking. It works because banks assume that not everyone will try to withdraw their money at the same time. Most of the time, people leave their money in their accounts, using cards or transfers instead of withdrawing cash. As long as withdrawals happen gradually, the system continues working. Problems can occur if too many people try to withdraw their money at the same time. This situation is known as a bank run. During a bank run, customers rush to take their deposits out because they fear the bank might fail. When that happens, banks may not have enough cash available immediately. Events like this played a major role during several financial crises. So if banks are lending out your money, how do they make a profit? The answer is interest. Banks lend money to borrowers and charge them interest for the loan. At the same time, they pay depositors a smaller amount of interest. The difference between these two interest rates is one of the main ways banks earn money. In simple terms, depositors provide the supply of money and borrowers create the demand for money. Banks sit in the middle and manage that flow. If banks lend out deposited money, why do people still trust them? There are a few important reasons. First, banks make it much easier to store and transfer money. Using debit cards, online payments, and bank transfers is far more convenient. Second, banks often pay interest on deposits, which means your money can slowly grow over time. Third, banks provide a level of security. In the United States, most bank deposits are insured by the government. This means that even if a bank fails, deposits up to that amount are protected. Finally, there is one more important concept: interest. When you borrow money, you usually have to repay more than the original amount. Interest is one of the most powerful forces. It can quietly build massive wealth over time or slowly trap people in debt. The same mechanism is responsible for both. To understand money, you first need to understand how interest actually works. Interest is essentially the cost of using someone else's money. When you borrow money, interest is the price you pay for that loan. When you save, it's the reward you receive. In simple terms, interest is like rent for money. If someone wants to use your money today, they give you back a little more later. There are two main types of interest. The first is simple interest. With simple interest, the amount you owe grows at a steady rate. You borrow money, and the lender adds a fixed percentage as the cost of the loan. The second type is compound interest. Compound interest works differently. Instead of charging interest only on the original amount, interest is added on top of previous interest. In other words, interest starts earning interest. And overachieving that can cause money to grow much faster. This is why credit cards can become so dangerous. Imagine you owe money on a credit card with a high interest rate. If you miss payments, interest keeps being added to the balance. Then the new balance starts generating even more interest. What started as a small purchase can slowly turn into a much larger debt. Interest can quietly turn small financial mistakes into bigger problems, but the same principle can work in your favor. When you invest money and earn compound returns, your investment can grow faster. For example, if your money grows at a steady annual rate, the gains begin to stack on top of each other. Over long periods of time, this compounding effect can dramatically increase the value of an investment. This is why many investors focus on long-term growth and patience. Compound interest rewards consistency and time. That is why interest can either become your worst financial enemy or one of your most powerful financial tools. If you are paying high interest on debt, it can slowly drain your finances. But if you are earning interest on investments, it can grow your wealth. The difference often comes down to who is paying the interest and who is receiving it. Now there is another force: inflation. Inflation is what happens when money gradually loses purchasing power. Your money might still say the same number on the bill, but over Chimie it buys less than it used to. Imagine buying the same product a year later and noticing that the price has increased. The product did not change, but the price did. That is inflation in action. Prices rise slowly over time, meaning the value of money declines. There are several reasons inflation can happen. Sometimes demand increases. If many people want to buy the same product, businesses may raise prices. In other cases, production becomes more expensive. Higher costs for materials, transportation, or labor can cause companies to increase prices. Expectations can also play a role. If people believe prices will rise soon, they may rush to spend money now. That increased spending can push prices even higher. A small amount of inflation is considered normal in most economies. Many countries aim for inflation of around 2% per year. Actually, that level prices rise slowly and predictably, but when inflation rises too quickly, it can create problems. Savings lose value. Wages may not keep up with rising prices, and everyday expenses can become harder to afford. To slow inflation, central banks often raise interest rates. Higher interest rates make borrowing money more expensive. When loans become more costly, people and businesses tend to spend less. Less spending can help reduce demand and stabilize prices. This process helps cool down the economy and bring inflation control. In the end, interest and inflation are two of the most important forces. Interest determines how debt grows and how investments compound. Inflation determines how much your money can actually buy. Understanding these two ideas can completely change the way you think about money. If you want to understand how money, investing, taxes, and wealth actually work, make sure to subscribe to Financial Hub, because the more you understand how money really works, the better decisions you can make for your financial future.